All right, time for our dollar dialogue discussion. And this week we want to dive deeper into what's really going on with the property market. So we're dialing in Jack Henderson, who's a prominent property personality / provocateur and director of the Henderson Group. G'day, Jack. Welcome to the Savings Tip Jar.
Very good to be here. Very good to be here.
Before we dive into all matters property, Jack, what have you got for your savings tip for us?
Savings tip. So I've got two. The first one is, if we're talking about property, the easiest time to save money is before you have life baggage. So as we get older, we have more things happen, and it becomes more expensive to live the same life. So to save for your first deposit, the earlier you do that in your life, the easiest it's going to be. The second thing is I'm a big believer in trying to earn more money versus trying to save as much as you possibly can, because there's a finite amount of money that you can save. You know, if you earn $1,000 a week, for example, you can probably only save 30% of that because you got to live. Where if you earn $3,000 a week and you still live on the same amount of money when you lived on 1,000, obviously that, 100% of the incremental increase can be saved. So I'm a big believer in always trying to focus on how can I earn more, and then everything you earn over and above your your threshold to live, that should be 100% savings.
Very true, Jack. Yeah. Geez, we're lucky. 2 tips for the price of 1. Thanks for that one.
I'll send you the invoice.
Yeah. But yeah, certainly on that first one, I can definitely vouch for that. I've got 2 kids now. We've got our place out in the Gold Coast hinterland, but the costs just keep piling up just when you think it's going to get simpler. But yeah, I remember when I was, earning far less, and I was just living in a 1 bedroom, 1 bathroom studio apartment above shops in Rosalie, Paddington. It seemed a lot easier to save money, even though I wasn't earning that much. But
it's true.
Yeah,
it's very
funny
true.
How sort of lifestyle inflation, how it really, as much as you resist it, it's a quite immovable force. Now, getting into this property market, it's all over the headlines at the moment. It's well entrenched in the national conversation. We've got everyone from pundits to media types to politicians all talking about it. I want to hear your take, Jack, as someone who's very heavily involved. I understand you believe this one it's not a crash. So I guess by the technical definition, a market crash is 20%. You're not expecting that. Why is that?
I'm not really expecting anything, right? The market will do what the market has always done, and the price decrease at the moment has been manipulated. If there wasn't policy change, then the marketplace would be in the same position it was prior to the policy change, which is obviously on the upward trajectory. So obviously Victoria went through this first when they changed all the tax policy down there around land tax, and there was a bloody lot of changes they did down there, but the main one was land tax. That turned the market because people were like, oh, well, it seems less appealing now to buy, and now it's happened obviously on a national scale. So no one knows how long that's going to last. No one knows whether the policy will stick. No one knows who's going to get in at the next election. So I don't know how far the market will come back. But what I do know is this has happened many, many, many times in the past, and we can obviously learn from history. So everyone wants everything to be cheaper, right? Like everyone goes, oh, I wish that was cheaper. I wish I could go back to X year or Y year and buy property then. I'd buy a heap. But the reality is, when we're in it and opportunities start presenting themselves, people look at it very differently. They're all very scared. So who knows what's going to happen? But what I do know is real estate's going to be significantly more expensive in 10 years' time than it is right now. So that's all I focus on, and that's what we focus on with our clients.
So we're sort of seeing, at this particular stage anyway, it's more the sort of the blue chip or the premium suburbs that may be seeing a little bit more of a drop-off in price. What does that say about how it's all playing out?
Well, the reason they drop by more is because they are a higher dollar value, right? So they can fall by more price or by more value. And again, history has shown this. Like the top end of the market, when it comes off, generally comes off by the most because there's less people that can afford to buy it, and there's a lower sales volume in that end of the marketplace. But on the flip side, when it goes the other way, the top end of the marketplace is, where you see those stories of houses in Vaucluse that were $4 or $5 million 15 years ago now selling for 30. So it's ebbs and flows. But obviously the affordability ban, there's still a lot of people who want to buy affordable property to live in or for investments. And there's a massive undersupply of it. So, that marketplace is relatively stable. And it also can't have significant falls because it's already cheap.
Yeah, certainly. Now, Jack, you touched on government influence a little bit there at the start, and we'll get into that a bit more a bit later because I know you've got plenty of strong opinions there. But I mean, a lot of those changes were sort of dressed up as, they kept saying intergenerational equity, as in sort of implying that, by keeping prices from continuing to increase or keeping those increases lower. I mean, they never said we were going to deliberately try and drive prices down. That would be fairer to younger generations and first-home buyers. But then we're seeing in the lending data coming out that loans to first-home buyers are actually dropping. It's not like they're all suddenly jumping into the market. So what's going on there?
Yeah, well, I mean, intergenerational inequality or whatever they were trying to call it, whether you believe that's a thing or not, let's just pretend that it is a thing. So what they're trying to do is obviously bring the wealth down of the wealthiest people and redistribute it. But if you change policy that then makes all asset values less appealing to invest in, then how, even if we redistribute the wealth, if something doesn't grow in value, then you're not going to build wealth. If you buy real estate today and it's worth the same value in 20 years' time, essentially all you've done is pay interest for 20 years. You might pay the debt down, but the asset value might have grown by the same rate of inflation, which means you haven't made any money. So it's actually not fixing anything. The reason first home buyers are not buying, or the reason lots of buyers are not buying, is because they're scared. Like, why? What happens if property is cheaper in 12 months' time than it is right now? What happens if it's cheaper in 24 months' time? No one starts buying again, or the masses don't start buying again until the media starts going, property prices are rising. Because then people are like, oh, I'm going to get in now so I can make some money. That's the only reason people want to buy real estate. They can dress it up and say we want to buy it to live in, but the reality is if I told you today that your property wasn't going to grow in value and it's going to be worth the same in 30 years' time and you've got to pay interest and all the costs associated with it for that 30 years, you would never buy it. You just rent. It'd be cheaper. But people buy it because it's an investment. It's your house and you can make money on it. That's how people retire in Australia. So, I think that the vast majority of first-home buyers and the vast majority of buyers will not start buying again until the media changes its tune and starts reporting that property prices are going to increase. And that probably won't happen until we start to see rates come down. And hopefully that's not too far into the future because of what the government's done to the overall economy.
So the big question there is, where does that leave investors? Is it even a thing anymore, property investment? I know you will say yes, but everyday mum and dad investors, what's in it for them? Is this the end?
Yeah, well, I mean, it depends on the time frame you look at the lens through. So if you look at the lens through the next 12 months, I'd say probably don't buy property because it's going to be too risky. I can't tell you that it's going to be worth more in 12 months' time than it is right now because nobody knows. But that would be the same for any investment, not just property. If you're investing for a 15, 20, 30-year time horizon, I would put the question back on them and say, do you think real estate is going to be worth a significant amount more than it is right now? And if you say no, then definitely don't buy it. But if you think yes, then you should. And then you look at all the data to support it. By 2040, we're looking like we'll have a population of 40 million people. The vast majority of those people want to live near our city centres. Which means we're going to have a denser population. We've already got a huge imbalance between supply and demand. Population is growing significantly faster than housing supply is. And I can assure you it is not going to get better if construction costs continue to increase. And we've obviously just got the natural market demand that will come when things normalize. So the mum and dad investors should ask themselves, if I do nothing, do I think I'm going to be in a bit better position than I am right now? And if the answer is yes, do nothing. Probably look at history and show, to work out whether that's going to be right or wrong. And if I think that by investing in real estate, I'm going to be better ahead or further ahead, then you probably should do it. I'm all in. So I think real estate, good quality real estate in good quality locations is not going to be cheaper in 30 years than it is right now.
Yeah, I do get the feeling that property price falls sort of naturally tend to correct because people are less likely to sell their home when prices are falling. So then when listings restrict, you've got fewer supply and then you've got buyers competing for a limited supply of homes on the market. And then you've also got the opportunistic buyers sort of sensing that the price falls are starting to bottom out, and then they think they can jump in and snap up a bargain. I suspect you only tend to see like 5 to 10% decrease nationally before people start jumping in and the prices start going back up again. So yeah, we'll see how that one plays out. But as promised, Jack, we're going to give you that free kick towards some of those government changes, because I know you've got some pretty strong opinions there. But not just the changes announced in the federal budget, but there's also one that hasn't been talked about as much, but we're quite focused on it over at Savings.com.au, and we've had a lot of readers coming in reading our articles about this, because we have a platform providing for SMSF property investors. Now, that one, they've announced that they are banning SMSF loans to residential property investors. So that one, in combination with the federal government changes announced in the budget, as well as some of the state government changes, like the ones in Victoria that were announced a year or two ago. What do all these changes combined mean for investors and the broader property market over the next 12 months?
Well, essentially what they're doing is they're going to turn, assuming this continues, they're going to turn Australia into a nation where housing is owned by corporations. Happened in states in the US, and obviously it's being changed now with the political power over there. But the reason they've turned off superannuation, and I had a politician on my podcast yesterday, it was just it was lobbying from the super funds. They pushed onto the Greens and said, make sure that you stop this and there'll be something in it for you. Because obviously if people are pulling money out of their industry fund, like your CBUS and Australian Super and all these big companies that are essentially influenced and nearly controlled by unions anyway, that means that money's coming out and it's not good. It's not good business. So they influenced it. They made sure that self-managed super fund lending stopped, and that means more money is going to be kept in the industry funds. But for wealthy people, most wealthy people, in their super fund, they probably buy commercial property anyway. I just bought a $6 million commercial asset in my super fund. So again, it doesn't affect the wealthy. It affects the everyday Australian who buys the 3-bedroom house, or the apartment, trying to set themselves up and have more control. I think the overall changes, regardless if it's associated with property or the minimum tax on trust, like all of that stuff, it was because the government was pandering to the minorities. So they were trying to say, well, let's punish these rich people and let's redistribute the money and let's give it to people who are not doing all that well. But what we know and what will come out in the future is that none of that money will go to the people who they're saying it's going to go to. Wealthy people always have the ability to minimize their tax and set up the new structure. And, there was a thing that Jim Chalmers said yesterday or the day before I wrote about it, where he said there was a record number of new companies that opened in June or July. I can't remember which month, 40,000 in comparison to a standard month being, late 20s to 30,000. And he made out like it was because of the strength of the economy, when in reality, the reason all these new companies have been set up is because he changed taxation on trust. So people are going, well, I'll move all my assets now into a company, or if I was trading my, company out of a trust, I'll now move it to a company. Like,
you do wonder, is it naivety or is it just,
obviously know that
lying? No. Is it?
It's because normal people or people who are uneducated don't know, and they think, oh well, that's good. Like, they've done these changes, the economy's getting better, and that's proof of it. But I think that Australia is smartening up. I think that, I'm not saying that Liberal or One Nation or any of those people are the solution, but if you look at what happened in the US, they swung hard left and now they may be swinging hard right, but it always ends up sort of evening out in the middle. And I think we're going to see a very similar thing in Australia, because higher taxes on, nearly everyone, lower productivity, one of the biggest public sectors per capita in the world. They're like not they're not pro investment in your own business, in other people's businesses, being the share market or the property market. Like, they've increased taxation on all of that. That's only going to lead to one thing, and that is people feeling poorer, unemployment increasing, and hopefully we get back to the prosperous Australia that we were not all that long ago.
We needed to end on a bit of optimism there, Jack. So I'm glad you steered it that way, because it was looking pretty dire.
We're too smart, right? Like, human beings, regardless if it's Australians or other nations. Like, the reality is, even that you look at the property price falls. If you are a hard Labor voter and you've got your own home, and let's say you're someone in your early 50s and you're thinking about retirement at 60s, your property's worth $1.2 million now, and in 3 years' time, it's worth $1,050,000 or $1 million. You can vote Labor all you want, but if your retirement now looks worse because they've changed policy that's not just affected investment, but affected the total housing market. Do you think you're going to be pro that or not pro that? And then obviously a lot of the big super funds are invested in real estate as well. CBUS is like one of the biggest super funds, and it's, big investment in real estate. So everything is somewhat attached to each other. And as everything pulls back, everyone's going to start to feel poor. And, you don't want that.
Never bodes well politically, does it? No.
That's right. And you're already starting to see it now. I've seen the AFRs post quite a few stories.
Yeah, I saw
Jim
that.
Chalmers is, slowly starting to reel back some of the policy that he made. It's going to be interesting. But if you've got I'm looking for a different word because I know this is a G-rated podcast, but if you've got the courage, I'll say, to invest, in a market where lots of people are not wanting to, right now you have the leverage. You call the terms, you call the price, and you can pick up deals that you only would have dreamed about picking up in late 23, early 24. That's what we're doing with that.
Warren Buffett. Good to hear, Jack.
Yeah.
Now, I can see why you are in the position that you are, Jack. You certainly know how to talk the talk and walk the walk and get people fired up as well and spring them into action. So that's why I called you a bit of a provocateur. You provoke people into action, but I think you also like to get, maybe incite a bit of rage in people too, judging by your social media.
If you don't change people's physiology, then you don't get a reaction or you don't get what you want out of it. You got to spark.
That's it, man. Yeah. Good stuff. Well, thank you so much for your very generous with your time on the Savings Tip Jar podcast. We've gone way over the 10 minutes that we told you it would be, but you've been very generous with your answers there as well. So thank you so much for your insights, Jack Henderson, on the Savings Tip Jar podcast.
Yes, thanks Jack.